Ngā mihi nui and welcome to Sector Report. For the next 2 weeks, we focus on a special investigation into one of the hottest topics in rural New Zealand as we ask, are the banks behaving badly in the way they handle their farmer clients coming under financial stress? Many say there are. Equally, many are perfectly happy with their banks. In this two-part rural banking report, we look at the red side of the ledger. First up, I talk to a farmer who's about to lose her property, a farm consultant who has an even-handed overview of the rural banking scene, and a Southland farmer who's waging a quiet and patient campaign for better and fairer banking practices in the rural sector. Later, we hear a fascinating overview from specialist rural accountant Stephen Stafford Bush. But first, travel with me to Fielding. Jeanette Walker is about to lose her 800-hectare hill country property at Pongaroa in the North Wairarapa. And she says that's thanks to her bankers. Hers is an instructive tale and a sad one, with many others around the country to match it.
I purchased Birch Hill in the middle of 2005, 2,000 acres of hill country with the bank's support. They understood that it was a development farm, needed quite a bit of infrastructure put in, and they were happy to fund that. Had drought in 06-07, which was particularly severe, and then 07-08, well, actually had 3 years drought in a row, which affected the bottom line, and at the same time commodity prices were pretty appalling. And the world financial crisis occurred. Basel II Accord came out, and in the first quarter of 08, banks were regulated by the Reserve Bank. They had new rules to comply with, and I was no longer viable, according to the bank. It was as simple as that, really. Their attitude changed within 6 weeks.
And what were the effects on you as a farmer?
My bank relationship changed very, very quickly. I'd gone to the bank in late February of 08 to say that I had concerns about the business and the drought and where to from here. They said that everything was all right. They actually valued my farm up. They'd valued it in 07 at 3.1 million. I paid 1.56 for it in 05, and they valued it up again at 4.2 million in 08. Which I found slightly ludicrous, and said that I had sufficient equity and to continue with the plan of establishing the farm and to go ahead and purchase more stock.
Which you did? Which
I did. And I was aware of my debt levels, but they were very encouraging of carrying on. And within 6 weeks I had a formal letter saying that they no longer considered my business viable.
Well, this must have queered your pitch in practical terms, running a farm.
No, hugely, because you have no overdraft. My overdraft facility was reduced to $10,000. Selling all your capital stock, which you've spent quite a bit of time building up, and that went to reduce core debt.
Yeah.
And then you still have to produce a positive cash flow and restock your farm with no support from the bank.
Well, what's your situation now, Jeanette?
The farm's up for tender. The bank still wants to sell it.
Does it?
Yeah. And the tender process is starting in a couple of weeks. And depending on how low the bank wants to sell it for, I think... there's just been no sales in the Taurua district that I'm in. There's only been 3 sales in the last 3 months.
So is there no way you can refinance?
No.
And
Did try that initially in 08. Went around to all the banks. No, the answer was no. That their overall response was that they weren't lending, and banks weren't lending for about 3 months at that time.
Chris Garland is a Lower North Island agribusiness consultant. With his large client base, he's got a handle on rural debt. He sees issues between banks and their farmer clients from both sides of the fence.
I would say that there might be 15 or 20% of our client base are in a sort of stressed situation whereby the bank might be refusing to advance any more credit, and they might find their accounts with a credit manager as opposed to a local branch. And I'm not sure what the figure is nationally. It would be slightly higher, I suspect, amongst the sheep and beef than the dairy at the moment. The dairy's pulling itself out a bit in terms of cash flow. The sheep and beef business has been less fortunate, and of course the season we're having at the moment is not playing ball, and we're going to have some difficult times for the next few months. So of those, to put in perspective, there's maybe 15 to 20% that are having some real difficulties, where the relationship with the bank could be quite tested. At the top end, there's about 30% of them that are having a very nice time. The strong balance sheets, strong cash flows, growing their business. Banking, new lending is very competitive at the moment. There's quite a few who are actually repaying debt, and banks are anxious to be getting that back out there working, so they're very accommodating to that top 30%. And in the middle, you've got maybe that 40 or 50% that are just keeping their heads down. They're treading water. They're not on the wrong side. They're still managing to service all their requirements as far as the financial arrangements go. And the bank's really not bothering them too much at all, and vice versa.
Chris Garland talks of a rating system used by banks to gauge the creditworthiness of a farming business. Sometimes they work for a farmer, sometimes they don't.
Since the credit crunch, they've internationally been tightening up banking regulations, and there's an accord called the Basel II Accord, whereby banks are required to rank their customers on the basis of the risk that they perceive with that client, and that risk might come from obviously their degree of equity or lack of, whether they've got positive cash flows or negative cash flows, what the immediate history has been with them, how strong they are as a business performer, and what their banking history has been. So, based on a number of other criteria, they are putting a customer margin over and above a base rate across these customers. And that customer margin, from what I gather, may range anywhere from 150 points or 1.5% up to over 4%. Some banks are being very upfront about that, and they're telling their clients exactly what they're doing and how it works, and this is what the number is, and this is what they can do about reducing it if they try. Others are being a little less upfront, and it's just sort of happening behind the scenes, and it's being loaded into their bank statements when the interest is charged. So it varies, but the difficult thing is that the customers that can probably least afford to have a high risk margin are the ones that are getting it. And I've had instances of clients that may have 3 million of debt, and that customer margin has the potential of going up 200 points or 2%. That's $60,000 more of interest they've got to pay because their balance sheet is weak and their cash flow is weak.
Farm consultant Chris Garland there. Back in a moment with more on our banks and their rural clients as we ask, are farmers getting a fair deal? Southland farmer Gray Eatwell has had his problems at the hands of a bank but is now in a healthy position. But he's founded a lobby group for bank customers and written a book on the way banks handle their customers. Gray says the banking industry now has a code of practice, but it's not working.
Clearly not, John, and I verify that by just the number of farmers that are currently coming to ourselves and other people to explain the tactics that they're experiencing from their bankers. Is clearly not working.
Well, what sort of tactics are you talking about?
The tactics really that I would refer to are the manner in which the Property Law Act is being used sort of as a rubber stamping tool. People are not giving adequate time to discuss their plans to remedy any financial issues that exist. The banks are taking a fairly hard line in a premature fashion. Where a farmer Where a farmer might have pressure issues as they do, they're not given the time to explain them to the banks prior to them taking recovery action.
Now, it's often said by critics of the banks that they change the goalpost basically when they're negotiating with farmers. Is that true?
Oh, well, absolutely, they have in this current round, and they certainly did back in the 90s when we experienced this. You only have to look at the advertising programs of the bankers, the products that they were promoting, and they were employing people who were agriculturally qualified people. Clearly they wanted to be involved in the decisions made as to where their money was being spent. They did that. They directed expenditure on many farms into various things that the farmer might not otherwise do. And then of course now they come back and say, well, the farmers were just gluttonous for their credit, when in actual fact the banks were the ones promoting it.
Simon Davies is a Taranaki dry stock farmer surrounded by dairying. He has no debt and therefore no banking problems, but like Gray Eatwell, banks shifting the goalposts during negotiations is something he hears of all the time.
The reason I found out about this was I've been in the market of selling some property and then buying some different property in an effort to step up in the farming business, and we've found that what was an acceptable value 6 months ago is now not an acceptable value. And so you've gone through the exercise of doing the numbers and working out what you've got to spend or look at spending on a particular property, and then 6 months down the track you do the exercise again and the numbers have changed. Basically what you could spend 6 months ago, now you can't.
It's hard to get reliable information on the number of farmers forced off their land, but there's certainly plenty of anecdotal evidence floating around.
Maybe 2 out of our whole client base. The banks, I have to say, have been very prudent about this whole thing. They understand there's nothing to be gained from causing an avalanche in land sales or in equity values, and they've been very circumspect. I have to say, on the positive side of the ledger, there's that. There's the fact that our banks have acquitted themselves well through this crisis. The other thing is they've got some good people in the field. The people on the ground amongst the banking fraternity do know the business, and they do have a good affinity with their clients. It's just unfortunate at the moment that some of those very experienced bankers who were through all the heady days of the 2002 to 6 are leaving. Some of them have just had enough. Some of them, it might be that they feel difficult about what's happened, but they've got a lot more regulation that they're having to deal with, and they're being replaced by less experienced people, and you've lost a lot of that institutional knowledge that goes between the bank and their customer. So in some isolated cases, customers' position has been misrepresented because of that changeover in personnel.
Of course, issues like this involving, a farmer and his farm, if it's under threat or stress, of course, it can become a very emotive issue. Do you find that sometimes emotions can cloud the facts of the situation?
Oh, it is. It is a very stressful situation. If you know that you're on the wrong side of the bank, in other words, you've not been able to meet your commitments, and particularly if there's a refusal to advance any credit, it's a very, it hits you right in the heart, because you can't buy your groceries. You've got to ask for every major bit of expenditure that you want to make. So yeah, it is tough.
A lot of farmers have sold. In fact, I have represented Sir Colin Meads over this issue. In fact, he's mentioned in the book I wrote about the subject, where they did sell their farms because they had such pressure from their bank, left them no alternative. And there's many, many people like that.
Of course, where farmers are under stress in situations like this, they become pretty emotive about the issues that are raised. Do you think there's, as we look at this whole issue of the relationship with the banks, that the facts actually can get a bit twisted?
Absolutely so, and I guess that's why we've tried to promote a more professional view. Mediation was one view. I still believe that some form of mediation is absolutely essential. The personal emotional side of it is fully understandable. We would have to say from our experience that the manner in which the banks address the issue to the individuals is somewhat draconian. They certainly don't allow that space, and it does cause a lot more emotion than might otherwise occur.
But of course there are plenty of good bankers too.
Oh, absolutely there are. In fact, you'd have to agree that the majority would be.
And what of the often made claim that the banks were too aggressive in their lending in the middle of last decade? It's something both victim Jeanette Walker and farm consultant Chris Garland agree on.
There was a very aggressive period of lending through about from 2003 to 2008, John, where banks were lending beyond their accepted margins on the assumption that equity values are going to lift, and so the margin would come into line over time. The reverse has happened. The banks are now finding that those accounts are now well beyond their lending limits, and they're saying, well, look, we can't bank you at this level. Not only do we want to see some debt repayment, we have to load your customer margin by X amount. So it's a double whammy. There's an hypocrisy there in my mind, because they were basically encouraged that lending. They were part of the problem that set it up. They need to understand that they're part of the solution, and I'd like to see them show more empathy in that situation, particularly where you've got a customer who's got a good customer history, they've got good integrity, they have no intention whatsoever to default on any payment. They need some time. It's that empathy that needs to come into this process.
There was a massive amount of credit available worldwide, and it's just part of the way the whole world was. And the banks, the 4 AM banks plus Rabo in New Zealand, they did go on a big campaign for market dominance. There's no two ways about it. They definitely did. And they were approaching farmers in existence and offering them other farms to purchase, and putting them into those farms with very, very little equity, less than 10% equity, and doing the budgets and to get the loan application through credit. And there was a lot of very loose lending.
People in the country talk between themselves a lot, particularly where property and money are concerned, even though some play it pretty close to the chest, usually for good reason. But word does get around.
I've been hearing some horror stories about farms being basically put up for sale by the mortgage holders, which predominantly are the commercial banks. And it's kind of scary, particularly in that I was unaware till very recently that a bank can sell you up if your equity level reaches, in their opinion, less than the mortgage is worth. I was always led to believe that providing you don't default on your mortgage, in other words, you pay your mortgage bill every month, you're fine. But that's not the case. And having now looked at my own mortgage agreement, I've found it to be true that if the bank, in its opinion, decides that your assets or what the security you hold or the bank holds against your mortgage is less than the mortgage, they can sell you up. Or they can call in their mortgage.
I decided to do a survey, which was done in the early part of 2010 through Massey University, through the Farmers Weekly. I got 128 respondents. 30% of them were comfortable with their bank, the rest obviously weren't. A lot of them chose to write letters to it. It was all anonymous, but some of them chose to identify. There's what you would expect when people are looking at losing their home, income, everything. Pretty depressed. A lot of the farmers, they felt a huge sense of shame about the whole thing. Some of them, it was the first time they'd actually written or acknowledged that they were in trouble. They hadn't even told their wives and partners or their parents.
And
so some of the letters were pretty awful, really. Yeah.
are there many that you've come across who've been put in the same situation as you, where effectively they're forced off the land?
On a daily basis, I'm talking, farmers ring me, and some of them have exited farming, they've been evicted and having to reevaluate their lives.
Coming up, we meet Stephen Stafford Bush, Chairman of the Institute of Chartered Accountants National Primary Sector Committee, and well placed to comment on the strong opinions coming from farmers on the behaviour of our big banks. Well, Stephen, welcome to the Sector Report here on Country 99 TV. There's a fair bit of noise coming from some farmers who feel they've suffered at the hands of the banks. I know they're a minority, but do you think they're justified in their claims?
John, I'm not sure that minority is quite the right word.
Okay.
Minority to the extent that, yes, they are less than the majority, but the numbers are quite vast, I think.
Are they?
Certainly in my practice, there would be anywhere between 5 and 15 clients who are struggling, and I'm just one chartered accountant south of Auckland. So nationally, there would be far more than that, and certainly from talking to colleagues of mine down the country and others, it is quite widespread, the effect that it is having on the farmers at the present point in time.
And you think their complaints are justified?
Absolutely, absolutely. A number of reasons, shifting goalposts, lending practices that if they were put in front of credit today probably wouldn't stack up, and in reality I don't believe they stacked up when they were lent in the first place 4 or 5 years ago.
When you talk about shifting the goalposts, can you be a little more specific about that?
Sure. The lending that did occur in the last 4 or 5 years, I guess, was predominantly equity based. So they had a look at what was the equity of the business. Generally over a reasonable term, medium to long term, there'd been pretty good growth in equity. So any downturns generally tend to be short, and growth in equity tended to mask any of those. And cash flow was to some extent secondary. Now they've completely turned that around. So primarily it's cash flow, and I think it's the way that it should always have been. But
why do you think that?
Well, at the end of the day, the business has to generate cash flow in order to continue to survive, to pay its debt, to continue to service the debt, to continue to reinvest in the business.
You've got to have money in, money out. You can't just have an asset sitting there. Is that what you're saying?
Yeah.
Well, one big gripe seems to be that an agreement will be reached orally, but there's no written record of it, and then things can just degenerate into a kind of finger-pointing exercise where nobody can agree on what actually has been agreed on.
I have a number of instances where that's the case. In fact, I wonder whether it's not always something that wasn't on record, but in fact something that's disappeared from the file, because it's not reflective of the bank's current position. I've got 2 instances of that, John. One where a client was lent some money. It was on the basis that when father passed away, that there would be a divvy up between the children, so money would be lent. The bank said yes, that was okay with them. Father died soon afterwards, and it was quite suddenly, and a significant amount of debt was then forgiven. So the cash flow worked better because there was interest being paid on that, and yet they wouldn't lend the small amount to divvy up with family. So now there's family issues. Another one where the family were asked to put some money in. They went to their parents and put some more money in. That was all fine with the bank in terms of the extent, and then later on the bank said, no, now we want some more. You need to put some more money in, or we need further equity partnership or a further injection of capital. So they are moving the goalposts. And one instance, which I've mentioned before, where the client said, well, it was on your record, they couldn't find it, we had a copy of it, we let them spend some time finding the files. No, it's definitely not on file. And when we produced their copy of what was said and agreed to, they were quite surprised.
I bet they were.
Yeah.
They wouldn't like that at all.
No.
In just preparing for this program, it became apparent that there's an awful lot of farmers who would like to go public, if you like, on the problems they've had with the banks, but who don't because they're scared that they might actually be victimised by the banks. Do you think they're justified in that attitude?
It's hard to know, but certainly that's a real fear for the farmers. I spoke to a number of mine who I thought might be interested in being involved. They said no because they feared retribution. And that's a very real fear for them, because at the end of the day, it's they who have to continue to work with those banks. And if there is any retribution by way of continuing to slash the overdraft facilities or make life very difficult, it does make farming for these people very hard.
Now, if we look behind these issues, Can we put the problems down really to aggressive lending by the banks through most of this decade when farm debt rose by, I think, $20 billion?
I think that's a very fair comment, John. The aggressive lending was something that they went through, and it was a combination of things. Several of the banks were trying to increase their market share, and through increasing that market share, they were too fearful that if they didn't say yes to a deal, the next bank that they were competing with would be down the driveway as soon as they drove out again.
And that was happening, do you think?
Absolutely, absolutely. Sure. And combined with the fact that the managers were actually being paid a commission for writing new deals. And I have a real issue with that, because
I was, quite frankly, when I was doing the research for this, I was surprised. I thought these were salary men, you know, that there was no special incentive for them to hand the money over from the bank.
There's many a bank manager, as a result of their commissions, have invested in farms and equity partnerships, I can tell you.
Is that right?
Yeah. I find it very difficult, because I cannot see how you can be independent in putting a deal to the credit department and approving it when, if you say, well, no, it's a deal that won't work, you're not going to get your commission. And from an integrity and an ethical point of view, I just cannot see how they can be independent sufficiently to, when it's not a goer, to say, listen, it just won't work, and sorry, you can't have the money. So those factors, combined with the chasing market share or increasing your market share, I think led to some deals that, frankly, John, should never have been done. And now farmers are having to deal with those issues now because they were done, and the bank's saying, well, they don't work anymore. Well, they didn't work when they did the cash flows then. We're now in a situation where the cash flow is much better than what it was when the cash flows were done, and still they don't work.
Just shows you what happens when you break the rules. Unfortunately, we've come to an end of our time, but thanks very much for coming in today.
No problem. Thank you very much for the opportunity.
Specialist rural accountant Stephen Stafford Bush there. I should mention that I have spoken to Federated Farmers President Don Nicholson, who's taking a keen interest in the banking issue. He says we should be careful in judging the issue, as there are always two sides to every story, and emotion can cloud judgment. But he also says there are aspects of the bank's recent behaviour which are unusual and warrant further investigation. I'll be back next week with part 2 of our rural banking special. Remember, until then, you can catch up with Sector Report on our website. See you next time.